on the on the uptrend, and record highs for the bank Nifty itself inching towards a life high. How are you viewing the current trend? And would you call it a pre-election run-up? Would you call it the beginning of a fresh run?
Good morning. Good to be with you back again. I mean, if you look at it on a broad perspective, I think it's a post-election rally that is happening pre-election. The smart money is getting in. They are positioning themselves against this present government coming back to power. And what would happen is once the election results are out, and hopefully if this government comes back, the retailers would get in, whatever be the Nifty level at that point. And this buying which has happened now, these shares would normally be sold to the retailers. So that's an old story happening again. The smart money always gets in before, and the local guy normally acts after the news. And we've always learned this ever since we came into the market, that buy and rumor and sell on news. So I think that's what's happening right now.
Basant, we saw a similar factor at 2004, where smart money bought ahead of the elections, and then you know what happened to the market when the election verdict was not favorable.
Yeah, sure. I mean, the markets did come down at that time. But then, if you remember, Nikunj, there was this CPIM leader who suddenly said, "Bhaan mein jaye share bazaar." And that's what spooked the market at that time. You don't want to be in a government where, you don't want to be looking up to a government which says, "Bhaan mein jaye share bazaar." Because for some people, share bazaar is life and death. And I don't think any of such a situation would happen. But even if it does, it was just a knee-jerk reaction. What happened after 2004 once the markets fell? I mean, they recovered in no time, and I think 2004 calendar year still returned a positive return. So there's a huge risk of not buying when, I mean, people would say there's a huge risk of buying when there is no clarity. I think there's a huge risk of buying when there is clarity. See what happened 6 months back. There was ILFS issue and all the NBFCs were written off. Of course, 90% of them would never ever come back to the same price, but the best one is ready to take out its all-time high. So I think you have to buy looking at the fundamentals, but we learned an interesting lesson last year that fundamentals isn't everything. There has to be something else which dictates why you buy and sell shares. So it's a mix and match of everything, but personally for our clients, for ourselves, we are more than fully invested and aggressively positioned.
Basant, hi, morning. Looking at the screen right now, I'm sure all those naysayers for banks at least, and who missed out on buying the Axis, even yes banks of the world, must be feeling quite left out right now. What's in it for banks now? Do you think there's still money to be made? Will the rally spread across outside of the ICICI Bank, HDFC Bank, or even Yes Bank to some degree, and Axis? Will it spread through to PSBs, or is it going to be very restrictive in nature as it has been up until now?
So if you have a one-year view, I think we don't own it, it's not a recommendation. Axis and ICICI will outperform HDFC Bank. But if you have a 5-year view and you want to go back to sleep, you don't want to be waking up each night thinking what's going to happen to the NASDAQ, to the Dow, to the SGX Nifty, I think HDFC Bank is still a no-brainer, not a recommendation again. So why I say 1 year and 5 year is ICICI and Axis, according to us, is playing a valuation catch-up. It's not a growth catch-up, it's a valuation catch-up. And with the new management coming in, I mean, for a 2 lakh, 3 lakh, 4 lakh crore asset book, how much money can one siphon off? 500,000, 2,000, and that's already been taken care of by the market. I'm talking about ICICI right now. And in Axis, you've got the bestest of brains coming from an insurance company. I think he's going to try and change the bank. But then this is not a 5-year bet in my view. We don't own it, so I can talk about it. It's a 1-year view, a 6-month view, or maybe a 9-month view. But that's for people who want to buy and sell, buy and sell. But if you want to still go back to sleep peacefully, I think HDFC Bank is there for you. And remember, HDFC did a QIB at 2200 last year, and those QIB guys are still to see the price. And HDFC is not another company in India which will do a QIB and never come back. So they also know that in 3 years they have to do another offering. So those guys have to make money, and the management will ensure that the guys who bought in at 2200 rupees last year would make money, because they have to do this repetitively to just make up the gap between the ROE and the growth. So I think HDFC Bank is also fine. I think all these big private banks are fine, but if you want to be a little cute and smart playing the PSU thing, I think that's very dangerous not to do.
What's kept you away then from Axis and ICICI Bank, though? I'm just curious to know.
I mean, we were already holding the companies which we own and they were doing very well. So, and in some cases, you don't want to sell a company just because you want to buy something else. So if you have fresh cash, you go and buy it. But normally you don't want to do all that tinkering unnecessarily. And we don't take, very small positions. We take normally 10%, 15% of our portfolio. So maybe missed it, or I don't know, but just that we don't want to tinker around, because the ones which we have also done quite well from the lows.
Which I keep on asking myself and everyone on the channel is that if I have to capture a 15-20% growth for next 5 or 6 years, or 5 or 6 is large, let's say next 3 years, I don't know, 5 is a difficult number for me to at least judge. Should I buy that at a P multiple of 20, or should I buy that at a P multiple of 40? Which is that, should I buy an expensive consumer dominated stock which will give me 15-18% growth for next 3 years at a high P multiple, or should I buy a cyclical stroke or corporate bank or a beaten down NBFC where I will still get 15-18% growth but at half the valuation?
Because I mean, a 20 PE multiple where earnings drop 50% suddenly becomes a 40 PE multiple. About 5 years back, I had umpteen number of people calling and saying, Corporation Bank le lo, iska dividend yield dekh lo, Dena Bank le lo, iska dividend yield dekh lo, and suddenly we realized ki lena ka dena ho gaya. So the point with this PE and the dividend thing is the consistency is the single most important factor in stock analysis, and we've understood that. I mean, sometimes you have to pay a lot of money, sometimes you pay little money to understand that. So if you are sure about it, see, 15, 18 isn't good enough for a 40 PE. You have to be about 25 or maybe around 25. So if you're sure of 25% growth for the next 10 years or next 7 years at least, not 5, not 3, I think I'd pay 40, 50 trailing to buy a 25% growing company for the next 5-7 years. But if the growth is in the 15 to 18 range, you go and buy an Asian Paints, you go and buy anything else, no recommendations again. So it's a little difficult to actually put your finger on the pie. But then what decides that PE is not just growth, it's the sustainability of that growth, the ability of the company to handle its, the situation and still deliver the growth. Like out of the NBFC space where 60, 70, 80% of the companies were almost wiped off their feet last October, you had one company which still came and delivered stellar results. So why not buy more of that? Because once the competition weakens, the market share shifting process becomes a lot more easier. And because different opinions make a market normally, that's what they say, but all opinions don't make money. And we've understood that we might have 200 different opinions, but then you have to go and act on that. Right now what's happening is everybody has an opinion, but nobody wants to act on that opinion. They're just waiting for something to happen. And that something would be 11,700 taken out before elections, maybe around the election time. And that's where the new gush of money is going to come in. I think that's where everybody would find something good to talk about and something good to buy in this market. Till that gets taken out, I think we'll all have our own fear about whether to buy or not to buy.
Okay, how did you insulate yourself in this entire NBFC stroke HFC slowdown? We know, everyone knows, the markets know that you've liked HFC stocks in the past, you've owned them, we've discussed this publicly, we've discussed that even on this forum. But at a time when there is a genuine challenge for HFCs in the NBFC sector, you think this is an opportunity for you to shift your portfolio to better quality NBFCs or HFCs? Or are you thinking twice about where the sector is headed because the dynamics have changed, the borrowing norms have changed, the way some of the NBFCs will have borrowed in the past from mutual funds, other entities, that surely will change?
So for the public, we don't own any HFCs right now. One which was being sold and there was an auction and somebody's going to buy it, somebody's going to sell it. We got fed up and we dumped it off about some time back, and we bought a great consumer company which I think should grow 25% for the next 5, 7, 8 years. We just own one NBFC and it's not a recommendation again, everybody knows it, it's Bajaj Finance, and we are more than fully invested into that as on the allocation perspective, and I think they should do fine. That's about it. And we make mistakes in life, Nikunj, and my mistake was balance sheet isn't enough. So it's like unless the Kanyadan happens, the Baratis won't get the food to eat. So the Kanyadan didn't happen with the HFC and we got no food to eat. So after 2 years, the stock doubling, we almost sold when it fell 30-40% from the top. But that's how life is. You learn something new in life and then you move on.
What would you buy if if you had the extra cash right now, Basant, and maybe you do, if you were looking to put it in the markets afresh, even post-elections? Are you looking at cyclicals again, or where are you seeing that earning potential?
No, I don't think we should be buying cyclicals because nothing changes. It's the same country, same politicians, same politics, same policies. And sometimes I get fearful of the way this country is going to poll. It seems the politicians have formed a group to auction the entire country. Somebody says, I'll give you 6,000. Somebody says, I'll give you 1,500. Arey bhai, desh ka paisa, it's our money. I mean, the country can't be auctioned for politics. And then the election commission will come on charging somebody who distributes 500 rupees and one local liquor bottle, saying this is bribing. I think somebody should file a PIL in the Supreme Court saying that this kind of pre-election dole-outs should be completely banned from this country. Because if this happens, the new thing which has come up, I think you will not have Bangladeshis and Burmese people coming to India. You will have Indians going into Burma and Bangladesh. So I'm very fearful of what politics is going to turn right now. So you better be in the bestest of the consumer names and the financial services names. Make 2% less, but at least protect the 100 that you have brought to the market.
Okay, fair enough. There's been a lot of deal buzz as well, Basant, here in, when we're looking at a lot of companies deleveraging, some amount of consolidation, so on and so forth. Have you been tracking that? What do you make of it? It's clearly a positive, to see companies taking the initiative to sort of, deleverage and so on and so forth. But what's the outcome that you see of this going forward?
No, I mean the deleveraging thing is first you goof up something and then you go and deleverage. So what has happened to Jet? First they goofed it up and then nobody wants 200 pilots and 5,000 air hostesses going around airports protesting just before an election. So Jet was actually asked to just, extend its. I think these companies, a company like Jet, again not a recommendation, I think they've just been put on a respirator, or a ventilator for that matter. When your operating profit is less than the interest cost that you have to pay, at best what you can do is survive. Even if you can survive that, where is the cash flow to repay back the debt? A lot of our telecom companies are under this situation right now. So unless the big daddy of them all actually increases prices, it's going to, it's like stopping the oxygen flow from your peer groups. So I think in the telecom sector, a couple of companies are standing on the brink. So this deleveraging is not happening just because suddenly they've decided, let's go and reward the minority. Let's do something which is a little more business-like. It's happening out of compulsion. And deleveraging happening out of compulsion is never a great thing for shareholders. But deleveraging when it happens on a discretionary basis is great because normally the valuation of a company goes up multifold when it starts repaying debt out of cash flow. But if you repay debt by selling off your assets, it's something different.
Would you say the same about DLF also, Basant? The sizable QIP, 3,000 crore rupees, and they're almost close to debt-free now?
No, DLF, no recommendations again, I think is a different story. They don't have this problem of getting into bankruptcy, and I think that's a different story. So I'm talking about the telecom companies, the airline companies, where this deleveraging, I don't know how far it's going to take them, because this deleveraging doesn't guarantee them new life. It just guarantees an extension of the old one.
Okay. Basant,
and investors should be very mindful of what they are doing right now, because as 200 stock goes to 250 and you think something's changed. So no recommendations again. I've got nothing against these companies, neither short, neither long. It's just a view that we exchange.
Fair point. I mean, I always say that the most important aspect to understand equity investing is risk. We take equity returns for granted. In a bull market, you should never confuse, brains with the bull market, and I think that's what happened in 2017. Everybody had a view, everybody had ideas, and views and ideas, they made money, not because they were right or wrong, but that was the nature of the market. That's not my question to you, Basant. My question to you is that which are some stocks which you don't own, but you would like to own, you're confident of the business, you love the promoter, you're confident of the growth, but it's only price which is perhaps forcing you not to buy those companies or those businesses. But if there is a panic, if there is a crack, if there is a crash, you'll be a buyer.
I mean, we don't own them, and it's not a recommendation. Again, Axis is good, ICICI is good. So I don't know whether I should be giving out these names, but please don't buy it just because I am saying it. Do your own research. I think these two companies are good. Maybe in the consumer space, something which we don't own and something which you have liked for a while, Nikunj. I think Britannia looks okay. So, companies like these are okay. But again, not a recommendation for the viewer. He has to do his own work. But then, not that we're going to buy it, because what we own should do slightly better than that. At least that's the hope.
In positioning, Basant, do you think one should approach this investment, approach this election not as an event? Because like you and me have discussed in the past, that 8 out of 10 times markets have gone in this election year. And for those who are sitting on cash, if they find value, they should put money to work and they should not be scared of an election event. Yes, it could be binary in nature. Yes, it could have short-term implications of 5, 10, 15% in mid-cap stocks, but that should not really, in a sense, stop you from investing.
Absolutely. I mean, it's much, much easier to buy a stock and see it go down 30% than to buy a stock 10% above the price at which you first saw it. So if you missed a certain stock, then what are you going to do? You're going to buy the B or the C or the D names of that sector. And that's what investors shouldn't be doing. So if you're okay buying something 10% above after elections, then you should wait. But if you're not okay with that, then what you do is, if for example, if you missed stock A, then you'll say, let me buy B or C or D. And that's where the problem starts. So I think it's okay to buy. Let the stock fall 10%. Finally, it's a stock market. It's not a fixed deposit which is going to hit an all-time high every second. So you just buy it. If it falls, it falls. That's about it.
Okay, Basant, great to have you on the show as always, and do come more often.